Hi, I'm Kezia Samuel, Chief Market Strategist, bringing you my take on what drove the markets in the first quarter of this year. Diversification helped not only mitigate risks, but also seize opportunities amidst market volatility. A globally diversified, moderate risk 60-40 stock bond portfolio eked out a small gain of 0.3% despite negative returns in the U.S. equity markets. Tariff concerns and weakness in technology stocks sent the S&P 500 down 4.3% in that first quarter, ending a streak of 5 consecutive quarterly gains. The sell-off was concentrated, though, in a handful of large AI-focused technology companies dubbed the Magnificent Seven. You've heard me mention this powerhouse team before. That is Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. These stocks struggle to maintain their previous dominance amidst competition from China, but also those tariff concerns. Now, this marked a sharp reversal from prior years when Mag 7 dominated stock returns. Also, within the U.S. equity markets, there was wide dispersion. If you were a defensive company that pays dividends, you had positive returns. On the other hand, fast-growing technology companies posted their worst quarter since 2020. Also, size of companies mattered. The smaller you were, the more you struggled, given reliance on domestic growth where policy uncertainty dominated. As U.S. stocks lost ground, international stocks gained when investors went looking for cheaper opportunities. Within international equities, there are two highlights. The first are stocks in Europe. They rose 10.9% due to changes in Germany's constitution that were designed to stimulate growth and also enhance the region's defense capabilities. Also, stocks in China gained 15% on AI enthusiasm. Finally, bonds gained as investors shifted their concern from inflation to recession, looking for safety, and gold, the ultimate safe port in an economic storm, gained 18% as the best quarter since 1986 as the dollar weakened. We also experienced something else in the first quarter of 2025, and that is that 10% correction from its last peak in February of this year. While no one likes a market sell-off, they are sadly quite common. In fact, on average, since 1980, the S&P 500 experiences a 14% correction intra-year despite ending the year with positive returns. As tariff uncertainty remains, investors need to keep their seatbelts fastened in this investing journey, as the ride sadly is likely to remain bumpy. Now, one thing is clear: the markets are going to keep us on our toes. We will continue to keep you informed as more shifts develop. This has been my take on the markets. Until next time, I'm Kezia Samuel.